Alright guys, I'm going to be explaining all the basic trading concepts in one video. In this video, you're going to be getting a handful of all the basic trading concepts I listed out in the class. So the first one I said is FX. FX. And I said FX is an abbreviation for Forex. It simply means Forex. You can hear people say, I'm an FX trader. They simply mean I'm a Forex trader. The next concept I explained is pips, and I know I've taught this before. Pips. We also have pipettes. We have pips. We have pipettes. Okay. Pipette is this last number here. Okay, that last number is called pipette. Is not really is not much relevant like that. It's just like you having 200k in your account, 200,000 in your account, then point maybe 30 kobo. That 30 kobo is still part of your money, but it's not really relevant like that. Do you understand? If somebody asks you how much you have in your account, you won't say 200,000, 30 kobo. You will not be. You just tell the person 200k. So that's how this pipette is like. It's not that it's relevant like that, sha. Okay, so the next thing you want to have, the next thing I talked about. Okay, let me explain the pips. Pips. Okay, so let me go to the chart. Okay, let's see. Currently, the price of Euro USDT. The price of Euro. Look at this line. Are you seeing it? This line, like, as it's moving, as those numbers will be changing, going up and down like that. That is the price of the market, right? 1.04887. Remember, I told you the last number is pipette, so don't bother about that last digit there. It's pipette. Don't bother about it. Now, look at the price of Euro USDT. Let's say it goes up to the price now later is now 1.0497. That means from 1.0487 to 1.0497, how many pips you have? How many did it take? How many? We say pips is the measurement of, is the change in the price of a currency pair. This was the price before, right? Now the price has changed to this. How do we measure the price? We measure it in pips. So you will say how many pips did it take for it to move from here to here. So from this number to this number, if you calculate it, it's just 10. How did we calculate it? It will take 1.0487. 1.0487. If you add 10 to it, you will get to 1.0497. Are you seeing it? The same way, if the market is at maybe this number, maybe this price is not here. Let's say the price is here, okay, at 1.0587. And the price now later on you check and the price has gotten to this 1.0524. So how many pips? You will not say how many number. Oh. Don't say how many number did it change from here to here. You call it pips. How many pips did it move? How many pips movement? So we call it pips. How the change in the number of a price of a currency. Are you seeing it? So from here to here now is what? Calculate it. 1.0587. 1.0524. If I minus this now, is what? This is 3 here. This is, if you minus it, you have 3 here. 7 minus 3, 8 minus 2 is what? Is 6. All these ones with 0, 0. So it's 63 pips. It's just, you don't even really need to be doing all this mathematics stuff. It's just for you to use your head knowledge to calculate it. If something moves from 1.092 to 1.072, if you look at these two, what's the difference? You know it's 20. So it's 20 pips. Alright, so that's it. Then you move into the next concept. Okay, and I told you that there are two assets that are calculated differently. Gold, that's XAUUSD, is calculated differently from other pairs. gold, and then any pair that has JPY, any Japanese yen pair. It's still almost the same thing, okay? Let's say Euro JPY is at 1 point, sorry, let's see, let's add a JPY pair. Okay, I have a JPY pair here, USD JPY, okay? Are you seeing how their number is? Their number is different from every other kind of number. It is not 1 point something or 0 point something. It's 150 point. Are you seeing it? So you have 3 significant numbers before the decimal. So 150.90, and this is the price of USD JPY. Then it now gets to 150.40. How many pips is this? What did it take for it to move from here to here? It's 50. If you minus it, is 50 pips, okay? That's how to calculate JPY pairs. You do your subtraction or addition depending on if it's a buy market or sell. Okay, so the next thing I want to explain is lot size, okay? And how do you see lot size? When you want to place an order, which I've taught you if you watch the video, click on Euro USD, click on new order. You can see you place your lot size is the quantity you want to buy. I can go to the market and buy 1 cup of rice. Another person goes to the market and buy 1 derica. Another person goes to the market and buy 1 pint. When we cook finish, it will not be the same outcome. One person will be bigger than another person. And if the rice is bad, the person that bought 1 pint will incur more loss than me, because he bought it with, let's say he bought 1 pint of rice for 5,000, for example, and the person that bought 1 derica bought it for 2,000, and the person that bought 1 cup bought it for 500, for example. Are you saying? So if the rice turns out to be bad, the person that bought bigger with bigger amount of money has lost more money. So the same way, that's how lot size is. It is the quantity of the currency you are buying. If I begin to, this is the lowest quantity, okay, 0.01. If I begin to increase it here, watch, as I'm increasing it, as I'm clicking on that player, this thing is increasing to, okay, 10, 11, 12, 13, here, like that. So the bigger the number of lot size I use to trade, the bigger my profit will be. The smaller the lot size, the smaller my profit. In the same way, the bigger the lot size I'm using, the bigger the loss. The smaller the lot size, the smaller the loss. So that is lot size for you. The next thing you want to know is base currency and quote currency. Look at these currencies. Remember I said they appear in 2. So one of them is the base currency, one is the quote currency. These numbers, the currency that appear first on the line, when you have 2 currencies paired together, the currency that appears first is the base currency. The currency that appears second is the quote currency, okay? So you can have these 2 currencies. For example, you can have Euro USD, and then you also have USD JPY. In this scenario, Euro is the base, USD is the quote currency, because Euro is the one that came first. In this scenario, remember in this first example, USD is the quote currency, but in this example, now in this currency pair, USD is the base currency because it appeared first. So any currency that appeared first is the base currency. The one that appears second is the quote currency. Now, why do we call it base currency and quote currency? It's base because when you have Euro USD, for example, the moment you click buy, anything you click buy or sell is this one that is affected. Is the base currency that, listen, it is the base currency that is always affected when you click buy or sell. So if I click buy, it means I'm saying Euro USDT, I want you. Automatically I am selling off USD. If I click sell, it means once I click sell, it means I am selling Euro USDT and I'm buying USD. I'm selling euro and buying USD, okay? So what I'm trying to say is that whether you are buying or selling, anything you do, it is the base currency that is being affected. So let's say they tell you that United States of America, their country is growing stronger, and their economy is booming. USD is going higher, and you have Euro USD. And that means you want to buy USD, right? You want to buy USD because the news says that the economy is growing and booming. So when you have this pair now, what are you going to do? Are you going to click buy or sell? You are not going to click buy, because if you click buy, remember I said anything you click, it is the first currency you are affecting. So you are not going to, if you click buy, it means you are saying you are buying euro and you are selling off USD. Their economy is strong, United States, so you have to buy this. So for you to buy this euro USDT, it means you have to click sell. In this case, euro USD, for you to buy it, for you to buy USD, that means you need to, when you come to euro USD, you will click sell, so that you are trying to sell off euro to gain USD. Do you understand? But if you come to USD JPY, what you will click is buy. You will click buy, because as you click buy, it is the first currency that is affected, so you are buying USD. I hope that is clear. The next thing I explained is bid price, okay? Bid price and ask price. We say bid price is the price at which buyers are willing to buy, and ask price is the price at which sellers are willing to sell. So bid price, this is bid price, ask price, bid price, ask price. The line here is bid price, the line here is ask price, okay? So the bid price is the price at which buyers are willing to buy. So buyers are willing to buy in this price. So when you click sell, this is the price at which it will be used in your sell. Okay, this is the price. So this is the price you sell. This is the price why buyers are willing to buy. So you sell to them at this price. So this is the price. This ask price is the price at which sellers are willing to sell. So you buy at this price, okay? So it doesn't really make much. So the difference between these two numbers, bid price and ask price, is what we know as spread. So spread is the difference between the bid price and the ask price, okay? If I say I open this trade now, I want to trade, I click buy, okay, you will see that it will not start in profit. Are you seeing that it did not start in profit? It started with loss. So that gap is called spread, and that's why your trade always starts with loss, with the floating loss, okay, because of the spread, the difference between the two numbers. And that's what that's the commission of brokers. That's their commission, okay? That's their commission. So let's move on. You have time frame. Time frame is the period at which price movement takes place, okay? Is the period of time at which a price movement takes place, and is also the period of time at which a new candle forms. Look at this very well. Look at all these things. This is, let me click on the screen. As you can see, this is M1 1 minute time frame, 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour time frame, 4 hour time frame, daily time frame D1, W1 weekly time frame, MN monthly time frame, okay? So that's it. So that's time frame. So what does it mean? If you just tap your screen, you will see it. Tap your MT4 in the charts area, you will see it pop up. So you can change from daily time frame to 15 minutes. So what do we mean? Look at all these candles, okay? We have the red and the green. The red one You can actually change the color later on your chart by yourself. The red one is the bearish candle, is the candle for sell. So as it's going down like this, are you seeing that it's more of red? So it's the bearish candle. As it's going up, it's more of are you seeing that when the candle is forming, as it's moving forming, are you seeing that is green that is showing? But once the candle is going down, it will be showing red. Are you seeing? So time frame now is the period of time at which a new candle forms. Okay, yes. So in this 15 minutes time frame, before this candle finish for another one to start forming, it will take 15 minutes. So after 15 minutes, a new candle will start forming. Okay, a new candle will start forming. After 15 minutes again, that one will close, another one will start forming. After 15 minutes, that one will close, another one will start coming. You will learn more of this in candlestick patterns and candlestick anatomy class. The next thing you want to, so that's time frame for you, the period of time at which. Now I'm in 15 minutes time frame. That is why it will take 15 minutes for one candle to form. But if I switch to 1 minute, it will take 1 minute for a candle to form. So after 1 minute, this candle will stop forming. It will stop. Another one will appear. After 1 minute, another one will appear. Do you understand? Are you seeing that as it's moving, if it goes up, it will be showing green. As it's coming down, it will be showing red, bearish. So okay, so after 1 minute, it will close. Another new candle will form. Okay, we can even be here while I'm talking. You will see it close now, and another one will form. Yeah, another one form. So the next thing I want to talk about is go long, go short. Okay, I want to talk about going long and going short. So it's very simple. Go long means to, if they tell you go long, they are trying to tell you buy. Okay, are you seeing it? It has finished from another candle has started. So go long means buy. Once somebody say go long, it means buy. Once they say go short, it means sell. So long is buy, short means sell. Okay, that's what simply what it means. So another synonym, bullish. When they say somebody can say I'm bullish on Euro JPY, the person is trying to say I'm looking forward to buying, or I believe it's going to buy, I believe the price is going to increase, I believe it's going to go up. That's what bullish means. Bullish. Okay, when they say bearish, they mean it's going to sell. Somebody say I'm bearish on GBP USD is saying I believe it's going to what? Sell. That means it's going to go down. The price will go down. It will sell. It will short it, go short. Do you understand? All these things are just similarity. Go long, bullish, bull. They means buy, buyers, go up, increase in price. Go short, bearish, bear, it means buyers, it means sellers, it means sell, yes. Go down, decrease in price. Go short, right? So you have ranging. Another thing is ranging. Now look at, market was bullish here. Are you seeing it? That means it was going up. In this place, market was bearish. Are you seeing it? Okay, so but in this place, market is neither going up or going down. It was just we call it ranging. It was just in between one place. Let me look for examples. Let me go to the maybe 30 minutes time frame and see where market was ranging. Like this place now, market was just ranging on here. Okay, so here now market was just ranging. It was neither going up or coming down. So ranging is in the market. You still learn this on market structure. In the market is either going up or going down. But if it is not really going up or going down, we call it ranging. You can draw a something like a rectangle. You will see that it's always ranging between that place before finally it will go up or go down. So ranging. Another synonym for ranging is consolidation. Market is neither going up or going down, it's just consolidating, is ranging. Okay, so the next thing I'm going to explain is trending. So if market is not ranging, then it is trending, and it can only trend in two ways. It's either it's trending up or trending down. Okay, so trading is when the market is making an upwards move, that or a downward move. So if it is not trending, if the market is not trending, that means if not making, you can say the market is in an uptrend. Remember, trending, uptrend, that means it's going up. Or the market is in a downtrend. If it's not trending up, that's uptrend. If it's not trending down, that's downtrend. Then it is ranging. These are the three ways market moves. If you are looking at your chart, you either see that it's trending upward, it's in an upward trend, uptrend, or downtrend. If it's not in any of these two, that means it's ranging. So the next thing is take profit and stop loss. This is very, very important for every trader to know. Take profit and stop loss. What's take profit and what's stop loss? Take profit is just is a predetermined point to exit a winning trade. Let's say you buy here now, for example. You buy here, for example, and you buy here, and then you've told yourself that okay, well, you expect it to go up, right? So when you place a trade, you set a particular price at which when as this thing is moving, when you get to that place, the market should close your trade for you. Okay, that means you are already winning. When you place a trade, let's say you buy, for example, when you buy, remember, when you buy, you are expecting the price to go up, abi? So let's say price is here now, okay, and I bought here. As I bought, I expect it to go up, so I can just say okay, when it gets to this point, to take my profit for me, I'm okay. So take profit is the predetermined point, the predetermined price at which I want to leave the market with my profit. Okay, so why stop loss is a predetermined point where you want to exit a losing trade. If you place a trade, two things can happen. It's either you are in loss, you are in profit, or you are in no profit at all. Yes, you can. It's rare, but you can actually leave the market without any profit. That you close without loss or without profit, but it's always rare. So if you are in profit, that point, that price at which you set already when you want to take that trade, before you take the trade, you would have already, before you place the trade, you would have already set a price that when I'm in profit, once you get to that particular price, close my trade for me in that profit, I'm okay. That's TP. It's called take profit. That's why we shorten it as TP. When you hear TP, why stop loss is when you set a price that okay, if market gets to this point to close, if I take a trade and it's not going in my direction, if it starts going against me, close my trade for me, or close my trade for me. Okay, close my trade for me. That's SL. Do you understand? You should understand. That's stop loss. It's called stop loss. Another thing I want to explain now is okay, margin is simply a portion of your funds that your forex broker sets aside your account balance for your trade to keep running. So if you have $10 now, you cannot just be opening trade and be opening, just be opening trade anyhow. It will get to a point, even if your money is still there, it will get to a point it will tell you no money left. As you have opened plenty trade, you want to open more, it will tell you no money, no enough money to open another trade. Because a part of your money has already been locked one side for those trades that is already on. Okay, some trades are already on, so a part of your money of your capital has been set aside for those trades that are already running. You have leverage. Leverage is a technique whereby you trade with more capital than you have. So you have $10. Usually you cannot trade the forex market before with just this kind of amount. It's too small. But today people are using $10, $5. It is because your broker gave you what is called leverage. Okay, they give you what is called leverage. You already know the meaning of leverage in a layman terms. Okay, so you can now you made use of that leverage. You are not going it's not like you are going to see, maybe you deposit $10, you will now see $1,000 in your account. No, it's still that $10 you are seeing. That's still what you are using to trade, but it is because of your broker's leverage. That's why you can use that $10 to be trading and even be trading more. So next thing you have is equity. Okay, equity is the balance on your trading account plus your floating trades. This is what we call floating trades. Are you seeing these trades now that are on? Okay, I have not closed them. It's still moving. I have not closed the trade. I have not closed it like this. I have not closed trade. You see, close with profit. Okay, let me close it. So I've closed that one now. So if I go to history, this is a closed trade. I've closed this one, but this one here now I've not closed it. It's still running. It's called running trade or floating trade. So equity is what? Equity is, this is equity. Equity is the amount, my balance plus whatever I have here. If it is loss or minus, that's my equity. Okay, so you have price action. Price action is actually the fluctuation of price on your chart. This is price action. All this movement of price as market is just moving here and there. That's price action. Okay, yes. So then you have market orders. Okay, I'm going to be explaining this market orders in a different video. So do well to ask your questions in class.